Welcome to the Deep Dive.
Great to be here.
Today, we're digging into securities law. Now, this might sound a bit heavy, but honestly, it affects pretty much everyone.
It really does. From individual investors, maybe like you listening, to the biggest corporations out there.
Exactly. And look, we know you want to get up to speed quickly, get the real insights, but without wading through pages of legal jargon.
Which is why we're diving into this really solid article covering the topic.
That's the plan. We're extracting the essentials for you. Okay, let's unpack this.
Let's do it.
We're going to explore, what is the real purpose behind these laws? How do they actually help businesses raise money? What's the day-to-day impact of complying?
Yeah, the practical side.
Where do the laws maybe fall short?
Important limitations.
And how do they try to make things fair and open? Plus, we'll peek at what's coming down the pike.
Sounds like a good roadmap. So, starting with the purpose, fundamentally, securities law is all about market integrity.
Integrity and openness.
Exactly. It sets the rules for how things like stocks, shares in a company,
Right.
and bonds, which are basically loans to companies, how those get issued and traded. But the real driver behind it all, protecting investors.
Protecting them from what specifically? Fraud?
Yeah, fraud is a big one, but also things like market manipulation, insider trading, using secret information for profit.
Okay, so it's partly about policing the bad stuff. But the articles seem to stress something more proactive, these disclosure rules.
Absolutely. That's key. It's not just about catching criminals after the fact. The laws force companies to give investors, both current ones and potential ones, all the material information.
Material information, meaning?
Basically, any facts that a reasonable person would likely consider important when deciding whether to buy, sell, or hold a security.
Gotcha. So forcing companies to be upfront.
Precisely. That transparency is vital. It helps prevent companies from, misleading people. It helps create a more level playing field.
And that builds confidence.
It has to. When investors trust they're getting reliable information and that the game isn't rigged against them, they're more willing to participate. That trust is what makes the whole system stronger.
And does that stability have bigger effects? The article mentioned reducing systemic risk. How does that work?
Well, by setting standards for how businesses should act and demanding clear financial reporting, these laws help build a more resilient market overall. When companies are open and accountable, there's less chance of some hidden rot suddenly bringing everything down.
Right, avoiding those domino effects.
Exactly. And of course, you have regulatory bodies watching over this.
Like the SEC here in the U.S., the Securities and Exchange Commission. The article really highlights their role.
For sure. Agencies like the SEC have the power to monitor the markets, enforce the rules, step in when things go wrong.
So active oversight.
Continuous oversight, yeah. It's crucial for spotting potential dangers early and hopefully heading them off.
Yeah.
It helps keep the market stable and, more equitable.
Okay, here's where it gets really interesting. No, it's good. The article dropped a fast fact about the SEC's recent work. In fiscal year 2023, they brought 784 enforcement actions.
Wow, that's a lot.
Yeah, up 3% from the year before. And listen to this. 501 of those were completely new, standalone cases.
Focused on what?
Things like major fraud, which you'd expect, but also crypto asset securities, a huge evolving area.
Definitely complex.
And cybersecurity issues. It really puts a number on their commitment, doesn't it?
It really does. It shows they're not just sitting back, they're actively engaging with the current challenges. Fraud, crypto, cyber.
Right. So the message for businesses is clear. Compliance isn't optional. Regulators are watching and they're adapting.
That level of activity absolutely shapes how businesses think about raising money, which brings us neatly to capital formation.
Capital formation. Okay, so this is basically how companies get the cash they need to, grow, innovate.
Exactly that. Securities law provides the whole legal structure for issuing and trading securities, stocks, bonds, the main tools companies use.
Right.
And this framework lets businesses tap into different pools of money, public markets, where anyone can potentially invest.
Like buying shares on an exchange.
Yep. And also private markets, which are usually for more sophisticated or accredited investors. This access is vital for funding growth, R&D, you name it.
So the laws aren't just restrictions, they actually enable economic activity, like oiling the machine.
That's a great way to put it. Think back to the transparency and disclosure we talked about.
Okay.
That builds investor confidence. If people, whether it's big institutions, venture capital firms looking for the next big thing, or just you deciding where to put your savings,
Uh,
if they feel confident they understand the risks and the potential, they're much more likely to invest.
Makes sense. You wouldn't invest if you felt like you were flying blind or the game was rigged.
Precisely. So more confidence generally means more capital available for businesses. It's a direct link.
Got it.
And there's another point. Securities law actually helps create the structure for new types of financial products.
Really? How so?
By setting rules, it provides a kind of legitimacy and framework. This can encourage financial innovation, bringing in different kinds of investors who might have different goals or risk appetites.
So more options for companies needing funds.
More diverse options, yeah. And again, by regulating behavior, trying to stamp out fraud, it just makes the whole environment more attractive for investment.
Okay, so following these rules is clearly important for accessing capital.
Yeah.
But how does actually doing it affect a company's daily life, their operations?
Oh, the impact is huge. It touches financial reporting, definitely. Also, how the company is governed, run internally, and how it interacts with its investor relations.
So it's not just a legal checkbox.
Not at all. Compliance is fundamental to building and keeping that investor trust we keep coming back to.
The article mentioned rigorous disclosure standards. Can you break that down? What does a company actually have to do?
Well, it means putting out regular, accurate reports on how the business is doing financially. Think quarterly earnings reports, annual reports.
The stuff you see in the financial news.
Exactly. They also need to promptly disclose any major events, material changes that could affect the business.
Like a big merger. Or losing a major contract.
Yes, things like that. And transparency around executive pay is another common one.
Why is all that detail so important?
It fosters trust. It shows the company is being open. It helps prevent any suggestion of, hiding bad news or misrepresenting things. And as the article hints, companies known for good, consistent disclosure. They tend to find it easier to attract and keep investors, which is obviously vital for funding.
Makes sense. And you mentioned internal governance, too. It's not just about the reports they publish.
No, it goes deeper. Securities law often pushes companies to set up strong internal controls and governance structures.
Like what? Board oversight, audits.
Yes, things like effective risk management processes, regular independent audits to check the books, sticking to good corporate governance principles.
So best practices for running the company.
Pretty much. And look, this isn't just about avoiding trouble with the SEC. Good governance can actually make the company run better, more efficiently, better decision-making. And of course, it helps avoid those potentially massive legal fines and reputational damage.
Okay, so securities law sounds pretty powerful, mostly for the good. But the article did say it has limits. It's not a magic bullet. What are some of the drawbacks or challenges?
That's a really important reality check. The intentions are good, but yeah, there are limitations. One huge one is just keeping up with the pace of change.
Technology, you mean?
Technology, absolutely. Think
Yeah.
about digital assets, crypto, tokens, or complex things like high-frequency trading algorithms. The law often struggles to keep pace.
So the rule book gets outdated quickly.
It can, yeah, and that can create gaps, gray areas where maybe new kinds of manipulation or fraud can emerge before the regulations explicitly cover them.
I see. What else?
Enforcement itself is hard and
Yeah.
expensive, especially with really complex financial products or companies that operate globally across many different legal systems.
Tracking down problems can be tough.
Very tough. And resource intensive for the regulators.
The article also mentioned the cost of compliance, particularly for smaller players.
Right. For big corporations, it's a cost of doing business. But for smaller companies, the burden of meeting all the reporting and governance requirements can actually be quite significant.
So significant it might stop them from accessing public markets.
It potentially could, yeah. It might limit their ability to raise capital in the ways securities law is meant to facilitate. So these challenges, the speed of change, enforcement difficulties, compliance costs, they can definitely impact how effective the laws are in practice at ensuring total fairness and protection.
Let's loop back then to that core goal,
Hmm.
transparency and fairness.
Hmm.
How exactly does the law try to achieve that, despite the limits?
Well, as the article lays out, it's a multi-pronged strategy. At its heart are those strict rules about disclosing financial information and rules about how people in the market should behave.
The basic aim being
Ensuring everyone playing the game has access to the same accurate, timely information. That's the foundation for making informed investment choices and hopefully having a fair market.
And for public companies, those disclosures are quite detailed, aren't they?
Oh, very. Those regular financial filings, quarterly, annual, they have to give a comprehensive view. Financial health, how the business operates, what risks it's facing.
All laid out.
The idea is to make it public so investors can compare apples to apples when looking at different companies. And it helps stop misinformation from spreading.
What about specific bad behaviors? The article mentioned insider trading and market manipulation again.
Yeah, the law tackles those head on. Insider trading, trading based on significant non-public info, is illegal. Full stop.
To keep the playing field level.
Exactly. Everyone should be trading based on publicly available information. And market manipulation covers a range of deceptive practices. Things designed to artificially inflate or deflate prices or create a false impression of market activity to fool other investors.
So trying to stop people from rigging the game.
That's the goal. And it's not just about stopping individual scams, it also ties into that corporate governance piece we discussed.
How so?
By setting standards for how companies should be run and how they report their financials, the law pushes for ethical behavior and accuracy from the top down. This accountability builds that crucial investor confidence over the long term.
Okay, looking forward now. What are the big future trends in securities law that businesses, maybe even investors, should really have on their radar?
Well, what's fascinating here is the undeniable rise of ESG.
Environmental, social, and governance.
Correct. Regulators are increasingly focusing on these factors. We're seeing growing demands for companies to disclose much more about their ESG performance.
Like what kind of things?
Things like climate-related risks to their business model, data on workforce diversity, their sustainability initiatives. It's becoming a standard expectation.
Reflecting broader societal concerns, I suppose.
Absolutely. Another huge area is, unsurprisingly, digital assets.
Crypto, blockchain.
Yeah. The regulatory frameworks for digital securities, for tokens, for crypto exchanges, they're still very much under construction.
So a lot of uncertainty there.
Definitely. Businesses operating in that space, doing ICOs, issuing security tokens, they need to watch developments very closely because the rules are evolving fast.
What about enforcement? Is that changing too?
It seems to be getting tougher. We're generally seeing a trend towards stricter enforcement of existing laws and potentially bigger penalties for breaking them.
And regulators are getting smarter.
They're certainly trying to. They're using more sophisticated data analytics, surveillance tech to spot potential fraud or manipulation earlier, which again highlights, the need for companies to have really solid compliance programs.
Makes sense. Anything else?
Globalization is a factor. More companies operate internationally, list shares on multiple exchanges.
Right.
So there's a push, albeit a slow one, towards harmonizing securities regulations across different countries. For businesses working globally, staying on top of international standards is becoming more and more important.
Okay, so pulling this all together, securities law, it's this really vital framework.
Absolutely critical.
Its main jobs are protecting investors, trying to keep markets fair and transparent, and, crucially, helping capital flow to businesses so the economy can grow.
That sums it up well.
But, as we've seen, it's not static. It's constantly evolving, facing challenges like technology and globalization, and it has real limitations.
It's a constant balancing act.
So what does this all mean for you listening in? Well, whether you're investing your own money, maybe working inside a company dealing with these rules, or just trying to make sense of the financial news, understanding the basics of securities law really gives you a valuable lens on how a big part of the modern world works.
It really does. And this raises an important question for you to mull over. As technology keeps reshaping finance, and we see totally new kinds of assets appearing, how do we strike the right balance?
Balance between?
Between strong rules that protect people and creating an environment where innovation can still flourish, where economic growth isn't stifled. And maybe also, what's your role as an investor or just an informed citizen in making sure companies actually live up to these standards of transparency and fairness?
Definitely some food for thought there. Thanks for walking us through that.
My pleasure.
And thanks to all of you for joining us for this deep dive.